Okay, so today we're going to talk about how to reduce your taxes with something called cost segregation. Now, you may have never heard of this, but it's an advanced strategy that takes place within multifamily syndication. It allows you to defer some or all of the taxes that you would potentially get in there. So there's actually additional tax savings where you could potentially even reduce your taxes to zero, which is incredible, if you can be what's called a real estate professional. So we're going to get into that as well, because for some people, they have an option for them, or maybe or for their spouse, maybe for you or for your spouse, to become a real estate professional. So stick around. We're going to talk about some amazing stuff that you're really going to love. So what I'm going to share with you now, this is not advice. I am not a CPA. I'm not a financial advisor. I used to be one. I'm no longer a financial advisor, and I don't know your situation. So this is simply for educational purposes, to try to help you in a way to kind of open the light of things that could potentially help your financial situation. So maybe you're a high earner. Usually people don't watch videos like this unless they're a high earner. They're learning, trying to figure out how can I reduce those tens or hundreds of thousands of dollars of taxes I'm paying every year. And this is honestly a wonderful way to do it. I've spoken with over 1,200 individual high net worth investors, typically net worth over $2 million. And I've learned a lot of things about this, about how this can be super compelling for people to learn. So stick around, it'll be good. This is basically 50.3 is the top tax rate. If you get to lucky enough to live in California, like where I live, that's the top tax rate. But there are people in California that are paying zero in taxes, or they're reducing their taxes significantly, particularly on their investments. So it's something to definitely consider. Now, I wanted to go over this really with stocks, is that you have short-term and you have long-term gains, right? So with stocks, if you're invested in stocks, if you're buying and selling, actively trading stocks, if you're flipping houses, you're doing short-term type of gains. It's typically 37% is the highest tax bracket. Some people are not paying that as much, plus a state amount. If you're holding it long-term, it's 20% plus a state amount. So how do we create a shield? So again, I'm an artist, as you can tell, but how do you create a shield so you can avoid paying some of the taxes that you don't want to or feel like you don't need to pay? So there are some tax advantaged investments we're going to get into here in just a second. Okay, so now we're going to talk for a minute about how cost segregation works. It's really not that complex, but I just want to break it down for you. So really what happens is we break the property down into four parts. And this is an engineering firm that does this. They come typically to a multifamily property. It works best. But you have land improvements, you have the building and itself, and then you have equipment or fixtures. So what they do is they'll bring forward the last two, which are building and equipment, and you can write off, basically take all of that depreciation, which is normally over a 20 to 30 year schedule, and they bring it forward to year one. So you get this big passive loss, which is typically 65 to 85% of the amount. What that means is $100K invested as a passive investor, you typically end up in a normal multifamily deal with a 65K to 85K paper loss. Well, what does that mean? You didn't make any money on the property in year one, but you have this big loss that you can use against other gains as the deal's going along. So for example, let's say you have $8,000 of cash flow per year. If you're getting 8% cash on cash, you're getting $8,000 per year of cash flow. And basically over 5 years, that leads up to about 40K. So over those 5 years, you're using this paper loss against what's there. Now, when you sell, if you've doubled your money, you will have some gains here. But what you can do is, again, when this property is sold, it allows you to basically, at that point, it recaptures. So you've deferred, hopefully, for 4 or 5 years, however long that period has been that you've had the property. And then what a lot of people do is they will basically roll into another deal and continue to kick the can down the road. So some of this is going to be write-offs where you're taking the depreciation, it recaptures, which means it goes back to actually the original schedule, which is typically a 20 to 30 year schedule. And so you do get some depreciation there. But if you just roll into another property, you're just continually pushing the taxes further and further down the road. So this really is very similar to what happens in something called a 1031 exchange. So a 1031 exchange is where you sell one property, typically a rental or commercial property, and you roll all the gains into another property. You just keep deferring taxes further and further down the road. So it's a great strategy. Now I wanted to talk to you about one other thing that may be relevant to you, and I want you to pay attention because this has the potential to potentially get your taxes to zero. which I've seen this in my own life, that it is possible to pay $0 in taxes. So if you're interested, keep listening. So we're always looking for shields on ways to shield our income and pay less taxes. So this is what's called a real estate professional. So if you Google that term, it says real estate professional, you're going to find out a few things. Is that basically you're able to actually write off ordinary income. So what it means is if I have a bunch of investments and I can use these paper losses of 65 or 85K, if I put more money, I can basically use those against my ordinary income, but only if I'm a real estate professional. So how do you qualify? You've got to have 750 hours a year that's what you do. And typically you document it, especially if you have another gig, so that you can show I put this amount of time into looking at real estate deals, being a real estate agent, being a passive investor, going and traveling, doing these things that are related to real estate. And it's got to be 51% of your time. So it can be difficult, but if it can work for some people that are physicians or other things. If you're doing 30 hours a week in your practice and 31 hours a week on average in real estate, there is a way to potentially be considered a real estate professional. Another option is to actually look at your spouse. If your spouse is currently not working, or if they're involved in real estate or they have interest there, they can potentially do this, and then you as a couple can qualify as a real estate professional. So an example of this is, I see people, for me, I've had a consulting practice for the last number of years, and I make a good income with that. But because of my business with multifamily investing, I've got a lot of these passive paper losses through cost segregation. So I've been able to reduce my tax to almost zero, or in some cases zero, which has been absolutely incredible. I've been able to save tens of thousands of dollars doing this. So this strategy works. Again, it's a little bit more of an advanced strategy. This is something you could talk to a tax person that specializes in real estate on, or if you want to have a conversation about it, I can offer you non-advice. I'll listen to you and share my own opinions, but feel free to reach out. So anyway, these are great strategies to be able to reduce taxes. So obviously, if you're interested in this video, you're going to be interested in finding out ways to do it. Cost segregation through multifamily is a huge way. Multifamily investing is a great way to reduce your tax basis. So if you're interested in learning about our deals, you can go to bronsonequity.com and click the join button, and you can basically get on our deal list, or we'll start a relationship with you. Second thing is we have this great report that I wrote about the single best investing strategy during and after a pandemic. You can check that out. Now we're going to go to our quote of the day, which is a really good one, and I'm going to share it with you. So it says, elections should be held on April 16th, the day after we pay our income taxes. That is one of the few things that might discourage politicians from being big spenders. So that's Thomas Sowell. He writes a lot of stuff about why it's important that we are good stewards, and obviously small government and things like that. So hope you enjoyed this video. Please like the video. It helps other people find it. Subscribe so you can get new content delivered to you as soon as it's available. We look forward to seeing you on the next video.